Learning outcomes. After studying this learning unit, you should be able to list the basic business forms found in South Africa. Explain the characteristics of a sole trader. Understand and apply the accounting equation concerning assets, equity, and liabilities. Explain the effects of financial accounting entries concerning assets, equity, and liabilities on the accounting equation. Prepare entries in general ledger accounts for assets, equity, and liabilities. Prepare a statement of financial position for a service entity. Key concepts: service entity, retailing entity, manufacturing entity. Forms of business: sole trader, double entry principle, T account, debit, credit, accounting equation, assets, liabilities, equity, income, expenses, statement of financial position, balancing off accounts, trade receivables, debtors, trade payables, creditors. Assessment criteria. The processing of accounting information by different piece of business entities because of the difference in operating activities is explained. The form of business ownership according to the capital needs of an entity is explained. The characteristics of a sole trader are explained. The elements of the general purpose financial statements are explained. Accounting terminology is explained, and examples of their use are given. The principle of debits and credits is explained. Business transactions concerning assets, liabilities, and equity are explained with reference to appropriate examples. Accounting policy is demonstrated according to the right methods and procedures when recording in the accounting equation format and in the ledger accounts. Assets, liabilities, and equity are defined and classified for recognition in the Statement of Financial Position. 2.1 Introduction. In the previous learning unit, you learned that financial accounting is an information system that communicates financial information to the users of financial accounting information. But who exactly needs to keep financial accounting records? The answer to this question is simple: everybody who earns an income. The average salary earner needs accommodation, food, clothes, and must pay, for example, the telephone account, school fees, and groceries. They would possibly open a clothing account and pay the school fees in monthly installments. Salary earners would also have a bank account into which their salaries are deposited every month. How would they be able to keep track of what has been paid, what they still owe, and how much money they have left without some form of financial accounting system? 2.2 Types of business entities. The processing of financial accounting information, that is, bookkeeping, will be determined by the operating activities of an entity and should be adapted to provide the information that is applicable to the specific operating activities. The operating activities of an entity are those activities from which it tries to make a profit. The objective of every entity is to earn as large a profit as possible. Mr. Bongil Sithole, a qualified electrician, has his own business which he runs from his home. Mr. Sithole trades as BS Electrical and installs electrical cables and repairs electrical faults. For him to deliver his services, he needs his tools. His clients must supply any cabling or wiring required for the job, which they buy from the hardware store. The hardware store buys these items from an engineering company that manufactures them. Mr. Bongil Sithole therefore runs a commercial entity which sells a service to his clients. The hardware store is a commercial entity which buys and sells goods to their customers. Commercial entities can be retail entities that will sell goods to the public, or wholesalers that only sell goods to retailer entities. The engineering entity is a manufacturing entity, which manufactures and sells goods to their customers. Each of these types of entities will make use of financial accounting records that are suitable to their own needs. The minimum information that must be available from these financial accounting records is prescribed by the International Financial Reporting Standards, IFRSs. 2.3 South African forms of business ownership. Mr. Bongil entity, the hardware store entity as well as the engineering entity may be conducted in one of several business forms. To start any business, money is needed. This money is referred to as capital. Some types of businesses require more capital than others. For example, the engineering entity would need machines, an electrician would need his toolbox, and the hardware store will need hardware inventory. The amount of capital needed to start and continue business operations would largely influence the form of the business. For financial accounting purposes, we distinguish between the following forms of business ownership. Sole traders, partnership, close corporations, companies. In South Africa, two types of companies can be formed, namely a profit company and a non-profit company. In this module, you will concentrate on the financial accounting records required by different operating activities, that is sales and services, of a sole trader, and we will not venture into any aspects of the other forms of business ownership. 2.4 Characteristics of a sole trader. This entity belongs to one person only. In the case of BS Electrical, the entity belongs to Mr. Bongil Sithole. It is suitable for smaller types of entities that do not need big amounts of capital to start a business. All decisions regarding the entity are taken by the owner and all the profits and losses accrue to the owner. Mr. Bongil Sithole will take all decisions regarding BS Electrical, and all the profit and losses will accrue to him as owner. Mr. Bongil Sithole is the sole owner and disposer of the assets of the business. The sole trader is not a legal entity distinct from its owner. Mr. Bongil Sithole will conclude any contracts applicable to his entity in his own name, and he will be liable in his personal capacity for the debts of the entity. As the sole trader is not a legal entity, the profits of the entity will be taxed in the hands of the owner. Mr. Bongil Sithole will declare the profits in his personal income tax return, and he will be taxed on the amount. If Mr. Bongil Sithole dies, the entity ceases to exist. If the business activities are taken over by someone else, a new sole trader entity comes into being. To be able to do Mr. Bongil Sithole's books, it is necessary to look at the accounting equation. 2.5 The elements of financial statements. Every entity implements a financial accounting system according to the minimum financial accounting standards and practices when it draws up financial statements that are used in making economic decisions. Financial statements will reflect the financial effects of transactions by grouping them into broad classes according to their economic characteristics, namely assets, equity, liabilities, income, and expenses. Assets, equity, liabilities, income, and expenses are called the elements of financial statements. The elements directly related to the measurement of financial position at a given time in the statement of financial position are assets, liabilities, and equity. Assets are all the resources controlled by the entity, whether they are owned by the entity or not, for example, land and buildings, vehicles, furniture, equipment, trading inventory, trade receivables, bank, and petty cash. Remember, not all assets controlled by the entity are owned by the entity. If, for example, the entity bought a vehicle on credit, it does not belong to the entity until the final installment is paid. Liabilities are the debts of the entity, all the money owed to third parties, for example, long-term loans, mortgage bonds, bank overdrafts, and trade payables. Equity refers to the amount that the owner invested in the entity and is made up mainly of capital. It is an indication of the assets that belong to the owner and is referred to as the profit or loss. Is frequently used as a measure of performance. The elements directly related to the measurement of financial performance for a period in the statement of profit or loss and other comprehensive income are income and expenses. Income less expenses equals profit for the year. Income is the income earned by the entity through its normal everyday business activities for the financial accounting period, normally a year, for example, sales, rental income, interest income, and credit losses recovered. Expenses are the running expenses of the entity for the financial accounting period, normally a year, necessary to earn the income, for example, purchases, rental expenses, telephone expenses, water and electricity, salaries, and wages. To be able to record transactions correctly, it is necessary to have a look at the process of recording transactions. 2.6 The double entry principle. Bookkeeping is the part of financial accounting that is concerned with the recording of transactions. The transactions are recorded in an account. An account consists of a left-hand side and a right format. The left-hand side is referred to as the debit side and the right-hand side is the center at the beginning of each account. The double entry principle provides a logical method of recording transactions. In using the double entry system, the monetary, money, value of each transaction must be entered on the debit side of one ledger account as well as on the credit side of another ledger account. The entry in one ledger account refers to the corresponding entry in the other ledger account. As the entries in the two ledger accounts have been entered on opposite sides, the use of the double entry system allows for cross-references. Each transaction is entered in two separate accounts on opposite sides, and it is therefore possible to check and control the arithmetical and accounting accuracy of the work. If each transaction is recorded so that the debit and credit entries are equal, the same sum of all the debits to the account must equal the sum of all the credits. This can be explained by way of the accounting equation. 2.7 The accounting equation, financial position. The logical method of recording transactions by way of the accounting equation is used to process transaction data. Transactions may affect assets and/or equity and/or liabilities, generate income or give rise to expenditure. The accounting equation states that assets A equals equity E plus liabilities L or equity E equals assets A liabilities L. The equity equals all the assets in the entity less all the claims against those assets. Liabilities. The accounting equation is a mathematical equation that should always balance. The financial position of an entity is indicated by this equation. For the accounting equation to always balance, it requires the involvement of two accounts for each transaction. The accounting equation is, therefore, based on the double entry accounting system. Basic requirements for the accounting equation. A minimum of two accounts must be used for each transaction. The equation must remain in balance after each transaction. In other words, the debit side, A, is equal to the credit side, E plus L. Consider the following example of transactions that affect assets and/or equity and/or liabilities. Before the entity starts to do business, the accounting equation will look like this. Debit side equals credit side A equals E plus L. Possessions the entity owns equals amounts owed to the plus owner of the entity. Amounts owed to third parties. What the entity owns equals what the entity owes. 0 equals 0. Note that the recording of transactions is done from the point of view of the business entity independent from its owner, Mr. Bong-il Sithole. Every entity for which separate financial records are kept is a financial accounting entity. It is extremely important to see the entity as separate from its owner. Transactions entered by the entity must be dealt with from the point of view of the entity whose books are being done. Transaction 1. Mr. Bong-il Sithole, a qualified electrician, started a small service business, BS Electrical, on January 1, 20.6. He decided to deposit R40,000 business. Explanation. The entity received R40,000 in cash and the money was deposited in a bank account opened in the name of the entity. It cannot be Mr. B. Sithole's bank account. The entity must have its own bank account. The money, bank account, is an asset because it is a resource controlled by the entity. It can be used by the entity to do business. The assets increased because it was before this transaction. Owner is called capital and this increases equity. The entity now owes Mr. B. Sithole R40,000. Both the left-hand side of the equation, A, and the right-hand side of the equation, E plus L, now equals R40,000. The effect of this transaction on the accounting equation can be illustrated as follows. A equals E plus L bank capital R plus 40,000 plus 40,000. Note: the plus sign shows an increase of an element of the accounting equation and a minus shows a decrease in an element of the accounting equation. Transaction 2. On January 1, 20.6, BS Electrical bought a toolbox and tools to be used by Mr. B. Sithole on credit from Big Builders for R7000. Explanation: tools and equipment are resources controlled by the entity. It can be used by the entity to do business. It is an asset, so the assets increased. The entity owed money to Big Builders, a trade payable, so the liabilities would increase. A trade payable, creditor, is a person or entity to which the entity, BS Electrical, owes money. This debt is usually paid back within 1 year. The effect of this transaction on the accounting equation can be illustrated as follows. A equals Transaction 3. On January 1, 20.6, BS Electrical bought a ladder from Ladders, Thai, Ltd and paid R1200 for it via duct internet banking. Explanation: money, bank account, is a resource controlled by the entity. It can be used by the entity to do business. Assets decreased because money was paid by the entity. Tools and equipment, and other resources controlled by the entity, it can be used by the entity to do business, increased, thus the assets increased. The assets increased and decreased with R1200, leaving us with a nil effect. The left-hand side of the equation, A, equals the right-hand side of the equation, E plus L, R47000 equals R40000 plus R7000. The effect of this transaction on the accounting equation can be illustrated as follows. A equals E. Transaction 4. On January 1, 20.6, BS Electrical borrowed R50,000 from Unibank at an interest rate of 10% per annum repayable over 60 months. The R50,000 was transferred to the bank account of the entity. Explanation: the money received from Unibank increased the bank account. The bank is an asset and therefore the assets increased with the money received from Unibank. The entity, however, owed Unibank R50,000. This is an obligation, liability, to pay, and the liabilities increased. The left-hand side of the equation, A, equals the right-hand side of the equation, E plus L, R97,000 equals R40,000 plus R57,000. BS Electrical owes Unibank, who provided the long-term loan, the money. Unibank is a creditor, financing creditor, of BS Electrical. This long-term debt is usually not paid back within 1 year. In this case it will only be paid back over a period of 5 years 60 months. The effect of this transaction on the accounting equation can be illustrated as follows. L. Big Builders. Trade payable. For you as a learner of financial accounting, the reality is that the double entry rules are not one of those concepts that you can try to understand. You must learn them. When analyzing a transaction, the following 4 questions need to be asked. Which 2 accounts are involved in the transaction? Do the accounts form part of assets, equity, or liabilities? Did the assets, equity, or liabilities increase or decrease? Which one of the accounts must be debited and which one must be credited? Transaction 1. Mr. Bongil Sithole, a qualified electrician, starts a small service business, BS Electrical, on January 1, 20.6. He decided to deposit R40,000 business. The effect of this transaction on the accounting equation can be illustrated as follows. A equals A few things to remember. The date of the transaction. Date: the transaction took place on January 1, 20.6. A description of the other account affected by the transaction to make cross-referencing easier. Details: the account to be debited is the bank account and the account to be credited is the capital account. Cross-referencing to the folio number of the other account affected, FAL. It will be discussed in a later learning unit. Recording the amount of the transaction. The amount of the transaction is R40,000. Bank account is debited with R40,000, and capital account is credited with R40,000. B. The credit side of the capital account. Dr. Capital 2 Cr. D. T. Assets. A present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. Current. Non-current. An asset shall be classified as current when it satisfies any of the following criteria. All other assets, thus being assets that are not classified as current assets, will be classified as non-current. It is expected to be converted into money, realized, or is intended for sale or consumption, in the normal operating cycle. Non-current assets include tangible, intangible, and financial assets of a long-term nature. In this module we will only concern ourselves with tangible non-current assets. It is held primarily for the purpose of being traded. It is not the intention of the entity to sell non-current assets, but to use these assets over the long term in its business operations to earn an income. It is expected to be converted into money, realized, within 12 months of the statement of financial position date. Non-current assets are those assets with a useful life of longer than 1 year. Examples of current assets are. Examples of non-current assets are trading inventories, consumable stores on hand, trade receivables, debtors, accrued income, prepaid expenses, bank, positive balance, cash float, petty cash, land and buildings, vehicles, furniture, equipment, machinery. Liabilities can also be non-current or current, depending on when the liability must be settled. Some liabilities are payable more than 1 year after financial year end, that is, they are not payable within the next financial year. These liabilities are classified as non-current liabilities. Liabilities payable within the next financial year are classified as current liabilities. Non-current liabilities. Liabilities. A present obligation of the entity to transfer an economic resource as a result of past events. Current. Non-current. A liability shall be classified as current when it satisfies any of the following criteria. All other liabilities, thus being liabilities that are not classified as current liabilities, will be classified as non-current. It is expected to be settled in the normal operating cycle, usually 1 year. They are long-term debts and must be settled after 1 year of the statement of financial position date. It is held primarily for the purpose of being traded. It is due to be settled within 12 months after the statement of financial position date. Examples of current liabilities are. Examples of non-current liabilities are trade payables, creditors, bank overdrafts, current portion of long-term borrowings, short-term borrowings, accrued expenses, income received in advance, long-term loans, mortgages, debentures. According to these principles, the correct statement of financial position for BS Electrical is as follows. BS Electrical Statement of financial position as at January 1, 20.6. Assets are equity and liabilities. The bank account has transactions on the debit side and the credit side. To determine what the net result is, i.e., how much money is left in the bank account, the account must be balanced. An account with entries on both the debit and the credit sides must be balanced. To balance is to find the final amount on the account. To balance the bank account, add the debit side of the bank account and write down the total in pencil. R40,000 plus R50,000 equals R90,000. Add the credit side of the bank account and write down the total in pencil, R1200. The debit total of the bank account is more than the credit total. To make the two sides equal, the credit side needs an amount of R90,000, R1200 equals R88,800. This is the balancing amount and is recorded on the side of the T account that is the smallest, in this case, the credit side. It is shown as a balance C/D. The account is then totaled, the biggest total in pencil, that is the debit side total of R90,000, and the balance is B/D on the debit side. The bank has a debit balance because the entity has an amount of R88,800 left in the bank account which represents an asset of the entity. Dr. Bank 1 Cr. Day. Exercises and solutions. 3. Exercise 1. Define the concept of an accounting entity. Describe the financial position of an entity in terms of the accounting equation. Explain the nature of assets, equity, liabilities. Name 2 sources of financing. What is meant by the double entry principle? 4. Solution. Exercise 1. An accounting entity is any entity for which separate financial records are kept. The financial position of an entity in terms of the accounting equation. Assets equals equity plus liabilities. I. Assets are the possessions of the entity. Equity is the interest which the owner has in the business and which the entity therefore owes to him. Liabilities are trade payables interest or interests of parties other than the owner, s. Liabilities are therefore the debts of the entity. 2 sources of financing, the owner and trade payables. In principle, double entry means that every transaction has a dual effect on the elements of the accounting equation and that after every transaction the accounting equation must remain in balance. 5. Exercise 2. The assets of Maxi Services amount to R30,000 and its liabilities, trade payables, to R50,000. 6. Required. Calculate the equity. 7. Solution. Exercise 2. Use the accounting equation. The amounts which are given are substituted for the appropriate symbol and the value of the unknown symbol is calculated. A. E. Equals. E. Plus. Tom is the owner of Zebra Services, which offers a carpet cleaning service. On November 30, 20.6, Zebra Services owns equipment amounting to R100,000. Clients owe R40,000 for services rendered, and Zebra Services owes R20,000 to a supplier for parts purchased. Zebra Services also has R10,000 in cash in the bank. 9 required. Show the accounting equation and determine the equity. 10 Solution, Exercise 3.